Cathie Wood is once again reducing her exposure to Palantir as January 2026 unfolds, sparking renewed debate around how investors should position themselves in PLTR stock moving forward. Ark Invest entered the new year with a clear emphasis on disruptive innovation themes including autonomy, gene editing, and advanced air mobility. As part of this strategy, Wood increased allocations to companies tied to next-generation transportation, such as Archer Aviation and Joby Aviation, while also expanding her stake in Deere & Company, which she views as a long-term autonomy-driven opportunity. At the same time, Ark Invest continued adding select healthcare names, reinforcing its conviction in innovation across multiple sectors. Against this backdrop, Palantir stood out because Wood chose to trim her position by selling approximately 58,000 shares of the software company. This move was largely driven by profit-taking and portfolio rebalancing rather than any deterioration in the underlying business. Importantly, the sale represented less than 15% of her total Palantir holdings. Because of that, it does not indicate a loss of confidence in the company's long-term prospects. In fact, Palantir continues to demonstrate strong operational momentum and expanding relevance across industries. Further supporting this view, Wedbush analyst Dan Ives recently named Palantir as one of his top stock picks for 2026. Ives believes the company is on a path that could eventually lead it to trillion-dollar valuation status, driven by accelerating adoption of its software platforms and deepening integration into mission-critical workflows. Adding to the bullish sentiment, Citigroup analyst Tyler Radke upgraded PLTR stock to a buy rating on January 12th. Alongside that upgrade, Radke raised his price target from $210 to $235, signaling growing confidence in Palantir's earnings power. With the next earnings report scheduled less than a month away, a sharp move toward those price levels would not be unexpected. Historically, Palantir has displayed notable volatility both before and after earnings announcements. That pattern has often created sharp price swings in either direction. However, considering the company's accelerating traction across both public sector and commercial customers, the probability of continued upward movement appears stronger than the risk of a sustained decline. Palantir's expanding footprint suggests that its software is becoming increasingly indispensable to large organizations seeking advanced data integration and decision-making capabilities. At its foundation, Palantir Technologies builds and deploys sophisticated software platforms designed to help organizations make sense of vast amounts of complex data. These platforms enhance operational efficiency, strategic planning, and real-time decision-making across government agencies and private enterprises alike. While the company was once criticized for relying heavily on government contracts to drive revenue, management has made significant progress diversifying into the commercial market. Today, commercial customers account for nearly half of Palantir's total revenue, representing a major shift in the company's revenue mix and reducing long-term dependency on any single segment. Turning to recent stock performance, PLTR shares have surged roughly 159% over the past 1 year. While that gain may seem modest compared to the extraordinary 340% rally the company achieved in 2024, it remains an exceptional return by almost any standard. During that year, Palantir emerged as the top-performing stock in the Standard & Poor's 500 index, a feat that placed it firmly on the radar of both institutional and retail investors. Even when measured against broader market benchmarks, Palantir's performance continues to stand out. From a valuation standpoint, Cathie Wood's decision to trim her stake appears rational. PLTR stock is currently trading at a forward price-to-earnings ratio of roughly 225 times, which sits well above its already elevated 5-year average. The stock is also priced significantly higher than its historical enterprise value to earnings before interest, taxes, depreciation, and amortization multiple, as well as its historical forward price-to-sales ratio. In other words, a substantial portion of Palantir's anticipated future success is already reflected in its current share price. Wood's recent move can therefore be seen as a disciplined approach to locking in gains amid stretched valuation levels. Despite these concerns, Wall Street analysts remain optimistic about Palantir's growth trajectory. Consensus estimates suggest the company will expand earnings by approximately 39% in 2026, followed by 40% growth in 2027 and 34% growth in 2028. Given Chief Executive Officer Alex Karp's history of executing on ambitious goals, there is a credible argument that Palantir could outperform even these aggressive forecasts. That potential upside helps explain why investors continue to tolerate the company's lofty valuation. Recent financial results further reinforce this optimism. In its latest earnings report, Palantir delivered a 50% earnings surprise, posting earnings per share of 18 cents. Those results were announced on November 3rd and also exceeded revenue expectations by a comfortable margin. Following that performance, management raised its revenue outlook for the upcoming quarter to $1.33 billion, signaling strong visibility into future demand. Leading into the earnings announcement, Palantir also revealed new partnerships with major technology leaders such as NVIDIA and Snowflake. These collaborations underscore Palantir's growing role within the broader artificial intelligence ecosystem and highlight the strategic value of its platforms. Alex Karp has repeatedly emphasized that the company is experiencing genuine, meaningful, and sustainable growth. While he has acknowledged that valuations across the market appear excessive, he has carefully differentiated Palantir from companies he believes could struggle if an artificial intelligence bubble were to deflate. Even so, caution remains a theme among analysts. Stocks that post record-breaking gains often attract skepticism, and Palantir is no exception. Many analysts maintain hold ratings as a way to balance enthusiasm for the company's growth with concern over its extreme valuation. Among the 22 Wall Street analysts covering PLTR stock, 7 rate it as a strong buy, 12 recommend holding, 1 assigns a moderate sell rating, and 2 classify it as a strong sell. Taken together, these opinions result in an overall moderate buy consensus rating. The median analyst price target of $195.58 implies roughly 10% upside from current levels, which may appear modest but reflects a realistic assessment of valuation constraints. However, should the earnings report on February 2nd significantly exceed expectations, the most optimistic price target of $255 could come into reach. That scenario would likely require another round of upside surprises and continued acceleration in both revenue growth and profitability. For more stock news updates, remember to press the like button and subscribe. With that being said, I will see you in the next video.